Hello there, welcome to the channel. So today I want to take and revisit Carvana fundamentals. Okay, so wanted to take a look at Carvana here because they had just recently reported. And as you can see here from the stock, that this thing is just imploded. I mean, my goodness, it got up to about 350 a share, and now it's down in the $30 to $40 range. So just gotten the crap kicked out of it. Now, another story here is that from Market Watch, the apparently they've laid off 12% of their workforce, blah blah blah, stuff like that. So they are doing some layoffs. Their stocks in the tank. So let's go ahead and look at the fundamentals and see if we can kind of get a better idea as to what might be going on. So if we look at the financials, in my Carvana fundamental episode, what I had done is I had gone through the last 4 years of financials, and I went through and did, a vertical analysis trying to express the numbers as a percentage of the overall sales, and then did horizontal, what the growth is year over year. And I did this over the last 4 years on an annual basis. So going back and summarizing, we can see over the last 4 years from 2018, 2019, that, this company has had, they had a couple of things going on. So here we have our cost of sales, and they've been able to keep their cost of sales, from like 90% and then 84%. And so what they've done is they've been able to take their gross profit and gross margin, and over the last 4 years, they've grown it. So for example, in 2018, their gross margin was 10%. Then they were able to get that up to 12%, 14%, and 15% for the annual year 2021. So now let's take a look and see what happened in this quarterly report. So what I've done is I've just gone through the latest quarterly for the March quarter here. And now this is 3-month data. Now, here's one, this is like a real big problem, and you can kind of see why the stock's getting hammered and why they're doing layoffs. Okay, item one, first of all, their gross profit dropped, and their gross margin has now dropped to 8.5%. So, they were on the right track here. They were growing their gross margin from 10% to 15% over the last 4 years. And now all of a sudden in this quarter, it's just gone through the floor. They basically have dropped to below 10% gross margin. Now, we understand, right? It is quarterly data as compared to annual data. So there could be seasonal factors. However, that's a big number to drop your gross margin by that much. So what that means is their cost of their sales has gone up. It's gone up a lot, meaning that they're making less profit on every car that they sell. And overall, what they have is they have a loss of $506 million. So that's a significant loss, and that's only for the quarter. So they lost 506 million for the quarter, and that's more than their annual loss ever. So it's a pretty bad quarter. Now, what I did down here, and I'll show you this, is what I did is I tried to compare their sales. So I took the sales that they had up here for 3 months, and I just multiplied by 4. And if I did that, then their year-over-year growth would only be 9.16%. So now if we go back over here and we look at our horizontal and we look at the growth that this company has had in their sales, you can see that they were growing sales at 95%, 40%, 127%. So they were a high growth company. And now that's dropped to a growth of less than 10% if we extrapolate. Once again, there's more variability on the quarterly than overall on the annual, but still, this is kind of what I think the market is smelling out. So now an important thing to understand here, you have to finance these losses. Where did the money come from to support the company when it lost $506 million in one quarter? Let's go to the cash flow statement. So the cash flow, what you will see is over the last 4 years on the annual basis that from an operating perspective, it's been costing them money. And where they've been getting the money is they've been getting the money from financing. So whether that be via short-term revolving facilities, long-term debt, or other, or proceeds from issuing stock, et cetera, they have to finance these losses. So let's see where they finance this $506 million loss. Now, a couple of things to note. if we go down here in this whole section here is the operating cash flow operating here. And what you'll notice is that they are origination because they're financing cars, they're financing to buy cars, and they're financing to sell, et cetera. But in addition, when you add all that up, they actually lost a little more from operating. They lost almost 600 million. Now then, for investing, they still are building stuff. They're spending money, 220 million on plants and equipment and stuff like that. So where is all the money coming? So when you put that together, they have almost 600 million loss in cash here, 208 million here. So it's like 800 million of spending or losses that they have to finance. So it comes in from the financing. So one of the interesting things is here, proceeds from the short-term revolving facilities, 5.2 billion. Paybacks are 4.4 billion. And what you do is if you take the sum of these two terms, what you see is that they get 733 million. So for overall, 707 million is provided by financing activities, but 733 million of that. Okay. So all of that plus some was provided by what? The short-term revolving facilities. So these short-term, it's like a credit card. Now, of course, as a corporation, they have better rates, but these are short-term financing. This type of financing, from my understanding, is like what what are they doing? What's their business? They buy and sell cars. So they're going to buy a car, recondition it, try to unload it in 30 to 60 days. So what do they need? So in terms of a lender would love to lend to that because they'd be like, hey, look, I will I'll lend you, I'll put up $100 million for you to lend to do this, because basically you can probably charge them a decent amount of interest, and it's going to be short-term variable interest, right? So the thing is, if I'm a lender and I give them $100 million floor facility to allow them to buy these cars, I mean, I'm not fixed rating that. That's going along with whatever the 10-year, the 5-year treasury, which has been going through the roof. So you got to understand that the cost to finance the buying of these cars is going up. And this is actually really, quite stark here, that the entire loss, all the money they spent, it really came from this short-term facility. Right. That's how they financed this loss. They financed it by, basically having borrowing on a revolving credit on a credit card. So this is kind of really, really pretty bad stuff in a lot of ways. And then if I look as well, you can see that in other years, like you can see this as well. So in 2021, they financed $2 billion was coming from short term. And then over here, they didn't. And then over here, 267 million. So you can see, actually, that's kind of interesting, because if 4 times 7, that'll give you 28. So you can see that they're on record, on path to have a big use of short-term facility. I just find that kind of interesting, right? Because it's with interest rates going up, the cost of this money, the cost to borrow money to buy cars has to be going up. And then if I go look at the income statement and I look at it and say, well, what the hell happened to the gross margin? Why are they down to 8.5%? Well, maybe that's why. I mean, I don't know. I mean, we could dig into the financials and try to figure out if they estimate what their interest rates are, et cetera, and all that stuff. So that's where they're getting their money. And I would say that, there's a risk, because if you're a lender and you're lending money to this company and they're losing this kind of money, there is a potential there. There's a potential that, gosh, if they get themselves into trouble, that you're going to be out this money. The lender is going to be like, uh-oh, they're going to be out the money. So that's where I can see, one of the risks going on here. So now the other thing that happened because of that, if we go to the balance sheet, and when I look at the balance sheet, I mean, the main thing I look at is the two things, cash and cash equivalents. So I look at the cash equivalents, and then the restricted cash line. And as we discussed in the fundamental, restricted cash is, there's some limit on it. They can't use it for general running the company. It's probably, I'm speculating, but it's probably the floor facility. It's like, hey, you can't use that. You can only use that to buy inventory, to buy used cars that you're going to sell, something like that. So you can see that. So looking at a yearly basis, their cash was 89 million, goes up to 118, and then it goes to 329, and they're up at 636. But important thing to notice is that for this quarter, so in one quarter, they went from 636 million in cash down to 542. And when you look at that on the cash flow statement, it's minus 94. their cash dropped right over here, minus $94 million. So in one quarter, they lost $94 million in cash. So that's something to keep in mind too. Now, given the fact that, so this would be something like the burn rate. I used to work at like, I worked at like a startup company, and that's all us engineers were concerned about was the burn rate. What's the burn rate? Okay, you have $10 million and the burn rate is, $1 million a quarter. Okay, I get 10 quarters. That's how much time I have to get this product done before you run out of cash. That's always what we're concerned about. But so, let's try to annualize that. So we know where they burnt 94 million, right? So if that, where are they going to be at the end of the year? If they burn 100 million a quarter, 400 million, and they only have 542 million, they could really start getting short on cash. You see what I mean? So they burnt 94 million, call it 100 million, burn 100 million of 542 million, and they can't even use all that, right? A bunch of it's restricted, right? And so if it's like, I need money to pay payroll, they may not be able to go into the restricted for that. So this is why they're having the layoffs. This is where the business has deteriorated rapidly. And this is amazing how fast this has deteriorated. And they are in really trouble. They really are. Going back and looking at the stock, now you get an idea why this thing is sold off. They were smelling it. Like basically the speculators, whatever, must have kind of had, an inclination that this was going to happen. Now it's interesting. It's back here in 2021, somewhere around here, it peaked out, and it's been going down ever since. So, basically the market is smelling out that the business has deteriorated, and that's why it's in this bad position. So they had to do the layoffs. They really don't have a choice. It sucks for all those employees, but they really have no choice. They have to do something, because if they burn approximately $100 million this quarter and they only got 500 something million in the bank, if the business deteriorates worse, they burn another 100 million the next quarter, another 100 million. I mean, you're talking about a year. They have about a year of operating cash if the business goes to heck, and you have increasing interest rates, which are going up rapidly right now. The interest rates on a mortgage right now are, the average rate is something about 5.35%. The 10-year is up around 3%. For a car, your loans are 3 to 10 year now, somewhere in that range, but use 10 year as a proxy. This has skyrocketed. And so it's kind of interesting if you look at this chart, and we're going to put this here together. So putting on the chart, the candlesticks here, the candlestick chart here is the 10-year interest rates. And you can see as the interest rates started spiking, and we got up to a point of 1.6% here. At this point, this is when this stock started to like level out. And then it went a little further as interest rates went down, but there it peaked. This brown line is Carvana. And you can see that it peaked, and it's been going downhill ever since. And the reason it is because interest rates have started to really go up and spike. So it's like the market has smelled this out and realized, and probably people much smarter than me realizing like, hey, they're really going to take a hit on that profitability. They're going to take a hit because they have to borrow money to buy every single car that they're going to sell. And if they have to pay more to borrow that money, it's going to affect their margin. And hence, when we see the margin drop below 10%, as we did this quarter, it's like already too late. It's done. So in conclusion, Carvana, they may not make it. They literally may not make it. Don't do fundamentals, do technicals. The technicals already smelled this out. That's it for this one. Bye.